On page 16, we have an overview of the session, the objectives and what we seek to achieve, the line of conversations that we expect the speakers and the session chair to promote, as well as the outcomes. And we once again would like to enjoin you to please actively participate, especially during the question and answer session. So I'd invite up at this time the participants and those who would make this session happen. I'll start with the chair. He's the founder and CEO of Africa Impact Group. I introduced him earlier, and you'd find his profile in the brochure. Can we put our hands together for Issam Kliu? Joining Issam is a professor with Business School in South Africa. He holds both PhD and MFN in finance, as well as a BSc in management and economics. He's been in higher education for close to 20 years, teaching and researching in major business schools in the United States of America, Spain, United Arab Emirates, and South Africa. He's co-editor of Africa's main finance journal, the Africa Finance Journal, an editorial board member of Review of Development Finance, Journal of Business Perspective, Review of African Economics and Finance, and of course, he's also a visiting scholar, or was a visiting scholar at NYU's Stern School of Business, and served as deputy head of school Wits Business School, as well as director of research for about 3 years at Wits University's School of Economic and Business Sciences. Distinguished ladies and gentlemen, can we put our hands together for Professor Kalu Oja? The last two speakers I had introduced earlier, but you'd find their profiles as well in the brochure to save time. I'd like to invite, ladies first, they say, Mrs. Hajara Adiola, CEO of Lotus Capital Limited. Well, this is gender exclusion, so can we put our hands together one more time for her? She was the only female on that roundtable session, and is the only female again in this session. All right, so I'd like to invite also, last but certainly not the least, the Director for Financial Inclusion, CSR and PMO for Fidelity Bank Ghana, Dr. William Durban. Also note to inform, especially for the inquiries we've received, that the event has been transmitted via new media using the hashtag AR-CSR14 and the Twitter handle at ThesoPraxisNG. So over to you, Issam.
So first, I would like to thank our host for this wonderful lunch. And the session after lunch are the hardest, I know, so please don't take a nap. We're all watching you. So to begin with, the session today is Dissecting Financial Inclusion for the African Market. When the topic was given, I was thinking about what to talk about, and there's so much things, you know, looking online, what's financial inclusion, and then I get to the point where it's good to look at maybe the supply and demand side of it in order to know who are the players. So on the supply side, we have, first of all, banks and microfinance institutions. Those are the big ones. But we also have those new players, which we call impact investors, whether we're talking about Acumen Fund, who's sitting there, who's acting as a fund. We also have foundation. We have the London Foundation. We have the Toli Elumelu Foundation present here and talking about Afrocapitalism, which is the new buzzword in business. And this is the second group. And the third group of people I think we should include is corporate social responsibility and all the money that's around there. So those are the three sides on the supply side. On the demand side, I was trying to look at who are the players. Maybe we have, so the people at the bottom of the pyramid, so the poor in the villages or the poor on peri-urban region. We also have the youth unemployed, and that could be our brothers, our sisters, people coming from decent income level, but are unemployed, so they're excluded. A lot of them doesn't have bank account. So we need to find a way to include this youth population, and addressing the problem of youth employment is critical, and it's sitting on everyone's agenda, whether it's banks, government, and everything. So that's important to look at. And the last part, so youth and employment, people at the bottom of the pyramid, and the other one is, actually don't remember, but it's not important. With that said, we are going to introduce our panelists. First, we're going to have Professor Kalu Oja, who's going to give us a good presentation on his part, talking about the definition really of financial inclusion and touching on the private sector. So what the private sector is doing in the field to be able to address the problem. And after, we're going to present the two other professors, because I'm giving Hajara the name of professor. Thank you. In Islamic finance. All right, Professor Kalu, you can give your presentation. You can be sitting or standing.
Both of them? Okay. For those of us who teach for a living, we have a way of addressing the kind of problem that I'm going to be confronting. There will be a quiz at the end of my presentation. And if you think you're hearing stuff you've heard before, like a broken record in your ears, then you know you're sleeping, you stay awake. Okay. So when Brian is gone, after Brian made his presentation, my question was, well, why am I presenting? So my thunder has been stolen. However, by the time the discussion that the panel had unfolded, I realized that there is still a place for what professors do. They say those who can do, teach. And I say those who can make as much money can talk and teach about it. And that's why I'm in financial economics. And it gives me time to think and ponder about what is it that you do and what financial inclusion means. And understanding what it means to start with makes it easier to then understand the intervention that the private sector should have. And if you notice, my title has a specific focus, and that focus is the private sector perspective. To appreciate why to appreciate why that's important, a thought about the motivation of my intervention came in the form of these assertions or statement of relative fact. The first is that there's no economy reliant on the government as a major or dominant employer has ever really had sustainably inclusive growth. Think about it. Well, what does that mean? You can cast your mind back to countries that have attempted planned economy type approach to organizing production. How many of them succeeded? None. As a matter of fact, we have the craze today that the market, everybody is going after the market as the motivator for effective production. So enters a pertinent corollary that says, those of you who want to go after, follow the footsteps of China, state capitalism is never successful when you have an incoherent governance structure or a society that is polarized. Or does this bring to mind anybody you know? Most African countries, really, you do not have a coherent governance structure where the government steps in as a benevolent dictator, you say, is going to take things the way Mao started, and we started moving away from there until where we are with state capitalism, that the government is using, co-opting the market to foster efficient, inclusive production. If that is indeed true, any attempt that will be made to use the state, the government, as the main producer of goods and services is bound to yield some maladies. Non-inclusive and unsustainable growth is what you're likely to see. Secondly, you have the absence of the enabling environment for production, where the private sector and individuals would have been able to intervene with relative ease, will be difficult to have in place. So what do I mean by that? Take the Nigerian example. Has Nigeria been growing? Has Ghana been growing? Economic growth we're talking about here. Have these countries been growing? Of course. But why are we complaining about if these countries have been growing? Why? Because it's not inclusive. Why is it not inclusive? Because the growth is essentially in the form of reporting the foreign exchange earnings of our commodities. Africa produces what? From South Africa, the most advanced economy we have. I'm not talking about the largest economy in Africa, I'm talking about the most advanced economy in Africa. From there, we have situations where all we do is dig out our natural resources, our commodities from the ground, and do what? Sell. Without value addition. Okay, if you do that, you will see growth. The more of it you dig out, which is exhaustible, the more growth you see, right? Have you created any jobs? No, the same crew that digs, and incidentally, it turns out that it's not really us who are digging most of the time, depending on what commodity we are talking about. And you dig it out, you ship out. You get your foreign exchange earnings, you smile all the way to the bank. And that's where it stops. Nobody has been employed, and it's reported we have economic growth, but it's not inclusive. There are many food soldiers who would have liked to be part of digging and converting it and adding value so that when you sell it, not only have you created jobs at home, but you would have expanded the production base, which enables people who are not necessarily in the digging up of the resources to be able to start their own form of production. In the process, if the government were to use the proceeds from these commodities, resources, effectively, what would happen? There will be an enabling environment where the government is putting in place infrastructure, physical and institutional. Physical in the form of electricity, physical in the form of nice roads, physical in the form of efficient ports that will receive the goods that are importing, not just consumable goods, but inputs, intermediate goods that we're going to use to create additional production. So if that is not happening, what kind of growth would you have? Non-inclusive and non-sustainable growth. How do we resolve this problem? In other words, I've eliminated government. I'm not saying government is not good. I'm not saying production does not need government. I'm saying where a preponderance of our production has depended on government anywhere in the world has not been sustainable. Hence, we need the market. How do you get the market? How do you get the market? One, first of all, why is it that government is so bad at managing production? Government manages politically. The political ticket drives production, not the need of individuals. There is no skin in the game by the people who are driving the production. It is ours. It's not mine. You know, there's a difference. Remember when you were kids? You and your siblings you fight over stuff. It's mine, it's mine. You want to protect your toy or whatever it is. But if it belongs to mom and dad, you can play with it and break it. And who takes the blame? Okay. Here, who has a skin in the game usually is the private sector in an environment where the government is not up to its responsibility. So the best one to drive the way forward in a way that is inclusive and sustainable has to be the one that has a skin in the game. And if you do have a skin in the game, you're motivated by profitability, profit. If you're motivated by profit, guess how you're going to use the resources? You're going to use the resources that you have at your disposal efficiently. So if that is the case, this presentation is truncated. Can I read it? Yeah, no. So here is where the private sector comes in. And here the private sector comes in the form of financial inclusion. Financial inclusion is the substitute mechanism for providing enabling basis for the kind of production that will be inclusive and sustainable. You ask the question, what is financial inclusion? Because the debate that I heard from the earlier panel was this problem of defining financial inclusion. I heard stories about financial inclusion in the formal market and financial inclusion in the informal market. Financial inclusion is financial inclusion. And financial exclusion is financial exclusion. I.e., financial inclusion is essentially what? A measure of the extent to which economic agents, all economic agents, individual households, businesses, government units, all in an economy utilizes financial product or services, apparatus at their disposal to do what? To facilitate desired exchanges and particularly support the highest possible activity in the real economy. Does it exclude anybody? Does it define financial apparatus to be banks? Huh? Hello, guys? No. Does it define insurance companies to be the only financial platform? Does it define pension funds as only financial intermediary? Does it define micro financial institutions, micro insurance institutions as the only financial institutions? The objective of my presentation as is unfolding is to say there is room for you to become a financial services outfit that fosters financial inclusion by being creative, adaptive, imaginative, keen at discerning who your potential target customer is, having appreciation for the kind of landscape that your potential target customer will be operating the production activity. Once you've taken all this into consideration, you've become a part of that platform that would foster financial inclusion. Why am I going backward? There we go. Still talking about the effective way out. We have effective financial intermediation and sequencing of the implicit functions. The first big participation I had around financial inclusion had to do with when a set of researchers came from the World Bank, led by Michael Fuchs, to talk about a report on Africa's progress, 2012 report on economic report on African countries, and the focus obviously was South Africa. And my university hosted that releasing of the report. And Dr. William here has been knocking on academics every opportunity he's had. We talk about econometrics, structural model that is full of mathematics, and we'll lose you in the process of telling you what we are doing. And it happens not to be, I'm of course an apologist for my colleagues and myself, but it turns out that we all do not run afoul of what he considers the proper way to report your findings. And if you notice, there are no charts, no numbers, no graphs on my presentation. Yeah, so some of us know how to communicate. Otherwise, we will not be effective teachers, right? So, the point of my intervention in that discussion was the World Bank was so focused on telling us how badly Africa fares in terms of financial inclusion. South Africa was considered among emerging markets in terms of having a financial inclusion to the tune of 50%. And guess what? Even that definition was narrow. It was unbanked. How many adults, proportion of adults in the South African space have access to banking product? My question when we got into a debate, it was so heated, the following day we were called on national radio to debate the issue. And there was a gang up against me from the Ministry of the Treasury Department and from the folks from World Bank. The folks from World Bank, because they were eggheads, they were a bit sympathetic to my position. But the people from government were clobbering me over the head. Professor Oja is advocating Wild Wild West, all this creation of products that would cause more financial fragility. I said, hello, guys. And then the minister goes, this was the deputy minister, oh, by the way, we cannot have financial inclusion when people don't have jobs. So we are trying to create jobs so that they'll have funds to participate in financial inclusion. I say, hello? It's not a chicken and egg conundrum. It is fairly straightforward, particularly in the context of Africa. There ought to be a sequencing of the function of financial services firms. What should that sequencing be? Why is it important that we sequence? Well, what is our saving rate? The country with the highest saving rate in Africa at the moment is who? Take a guess. Yeah? Nigeria. And what's the percentage? We have smart students here. 23, 24%. Even the most advanced economy that used to be around 20 has gone down. The last count, it was about 18%. That's South Africa. Tell me, how are you going to produce a product that requires all inputs necessary to produce that item, but you only have 20% of the input? How are you able to produce the item? A relatively impossible task, isn't it? Hence, the need for sequencing the process to effective intermediation and hence inclusive financial services production. How do you do that? Savings. You do that by savings. Okay. And when you have the savings together, what follows is then the ability to produce diverse products, financial product of diverse denominations, meeting people at diverse points of their needs for production purposes. If you don't have that pool, there will be no product that will help people pursue their production in a sustainable manner. My time is up, so I jump straight to the story of the financial services firm. What is it that you need to do to be very effective at doing this? And the story around scale. My friend, the guy who wants to disrupt and take away, Patrick, and take away banks. I support you in ignoring banks, the way we understand banks, because banks are not effectively intermediating in Africa. So we do need other financial services firms to co-opt banks to effectively intermediate. And how do you do that? Scale. Economies of scale, economies of scope. What must be your target? Because you produce it at the high cost you described, which is true, then you're likely to make it affordable to the people that need it. Okay, I shouldn't go any further in terms of usurping other presenters' time. So I'll stop here. A point before I go. Sustainability is doing the right things continuously and consistently right in whatever increment. Persistent.
So I don't know if you remember when you were in school, but stopping the professor is not something you're used to. So you need to know how to deal with that. That being said, thank you, Professor. You brought very good points. First, how to combine economic growth with human development. That's a big topic. We're focused on economic growth, but for the future of Africa, we need to be able to make sure we look at human development as industry's targets, so education, health, affordable housing, and all of that. A second point I would disagree with you is that you mentioned intermediation. The banks aren't doing their intermediation effectively. I would say they are not serving the whole market. They have their market, but there's people lower that they don't serve. And I would say this is the missing middle. So people that are below $50,000 in loan or business size, that's a microfinance. People that are above a certain amount, I'm not sure what's the exact amount, it's probably $1 million or $500,000. The margin between the two isn't served by any financial institution, and that's where the impact investors are coming in. It could be a little more than that. And I found out who's the third party within the demand side is the informal sector. Those people, so it's divided three ways. So the informal sector, they have access to income and they have access to infrastructure bank, but they don't use both. Versus the poor and the bottom of the pyramid, they don't have access to the infrastructure and they don't have access to income. The youth and unemployed, they have access to the banks, but they don't have access to income. So that's how. The informal sector, well, I don't know how to address that. They have the money, they know where the bank is. I don't know why they don't go. They probably have their own reasons. Maybe they don't want to pay taxes, which I understand. Going 4 hours to go to work, it's not something where they feel they need to pay taxes for if infrastructure is not built for them. So that being said, I'm just going to talk about the role of government and move to our next one, who's probably going to be Professor Hajara. So I don't know if you followed the trend lately, but Professor Damisa Boyo is talking about the emergence of China. So now, like, all the African countries are like democracy, the US, the West, or we should all be democratic. If you're not a democratic country, then we are not going to give you aid, we are not going to do that and this to you. But China is emerging as the best partner. China, they have a communist party. They've been around for how many decades? And China, within the past 2 decades, have been able to get 300 million out of poverty and solve the financial inclusion problem. On the other side, well, the case of India, who's a totally democratic country, have still those 300 million people in poverty. So should we follow democracy? Or should we think the China model could be a good one? This is a hot topic for you to think about. Now I'm going to introduce Professor Hajara, who's going to talk to us about statistics within the financial inclusion space. She's going to talk about milestones attained by Nigeria, but also the central bank targets, and of course her area of expertise, Islamic finance, and how that could be part of the solution. Thank you.
Good afternoon once again. I hope you're not going to get Hajara fatigue, as some people get donor fatigue. And unlike the professor, I'm not a professor, so I'm going to have some charts and some figures to throw at you, just so you take me more seriously. Okay. Hopefully the presentation will come up. But as you said, my presentation is going to be looking at a few, or let me start again. What I found fascinating today is the various angles from which people are looking at financial inclusion. When I was preparing and I was getting my data and the definitions, I thought, well, everyone's going to be saying the same thing. But there have been so many different perspectives, so it's been very fascinating for me. My area, as we've talked about, is Islamic finance. And the question to ask is why Islamic finance? What does it mean? And how does it play a role in financial inclusion? Anytime it comes up is good. And I'll start by just defining what Islamic finance is and why we think it plays a role in this sector, just for some understanding. There are 3 or 4 concepts, key concepts in Islamic finance. The first, which incidentally is shared by all the Abrahamic faiths, that's Christianity, Judaism, and Islam, and I'll show you some quotes from the scripture once the presentation comes up. The first is that money in itself has no value, it's not a commodity. At best, it's a unit monetaire for transactions. And if money has no value, then how can it increase with no activity? In other words, I shouldn't be able to deposit money in a bank and get a return just for depositing that money. That money has to go through some sort of economic activity, be involved in some risk, have an asset behind it, and create some sort of value, productive value in society before an increment can be earned on that money. To give it a more philosophical underpinning, I'll share with you a proverb from a Native American group, the Cree Indians, who say, only when the last tree has died and the last river has been poisoned and the last fish has been caught, will we realize that we cannot eat money. And that's the concept behind Islamic finance. Money is only a unit monetaire. Links to that is that money has to be used backed by an asset, or any kind of Islamic financial transaction has to be asset-backed. And that allows 3 types of transactions. The first is sharing, what they call sharing, private equity, venture capital, partnerships. You get involved in a venture together, you take risk, you engage in it. If it's profitable, you share the profits. If it's not, you share the losses. The second is renting or leasing, and it can be a tangible asset or an intangible asset, where you're renting the usufruct of an asset. Now, the difference is if I was buying a car from a conventional bank of, say, 5 million naira, they would lend me the 5 million naira and I'd go and buy the car and pay back the loan. In Islamic finance, the bank would buy the car that you specified, and rent the car to you at a rental that could have the same economic rent as the interest rate, but the bank has owned the car and is selling you the usufruct of the car or the car itself. So the asset has been embedded in the transaction. And thirdly, you have what we call sale, which is just trade finance. I buy this clicker, I sell it at a markup, at a profit. So those are the three models, and again, I've taken the risk of ownership. I bought it first before I can sell it on to you at a profit, either spot or deferred payment. So even though sometimes the economic benefit can seem exactly the same as a conventional, the structure behind it is extremely different. And when things go wrong, especially, then you begin to see the differences in the transaction. Lastly, and most importantly, is that Islamic finance is underpinned by social or ethical screens. So you can't make money from anything you want. You can't go to the bank and take a loan to gamble, even if I have collateral worth millions of dollars, for example. Interests, for reasons I've explained already, anything considered harmful to society, alcohol, tobacco, pornography, gambling, and for the Muslims as well, pork are involved in that. So you cannot finance or invest in businesses that engage in any of those sectors. Okay. This is just talking about my firm, Lotus Capital. Like I said, I started the firm because I was financially excluded. I was offered a mortgage where I was working and I couldn't take it because it was an interest-based mortgage. And I thought, this is ridiculous. There must be something for people like me, and there must be many other people like me who need this. So Lotus Capital was established in 2004. We're regulated by the Nigerian Securities and Exchange Commission, and we're pioneers in Islamic financial services. We've pioneered several things. Last year, we were the lead issuing house in the first sub-sovereign Islamic bond, or sukuk, in sub-Saharan Africa. We also collaborated with the stock exchange to launch the Islamic Index, and we've also launched a mutual fund in 2008. Okay, just going back to the context of my presentation, I like these definitions of poverty, the deprivation of common necessities that determine the quality of life. And again, to be poor is to be deprived of goods and services and pleasures which others around us take for granted. And I think that's where the financial services and financial inclusion comes in. If you're not financially included, then effectively, by this definition, you're also poor. Okay. The definition I found for financial inclusion is a state in which all people have access to a suite of quality financial services provided at affordable prices in a convenient manner and with dignity for the clients. It's one of the nicest definitions I've come across. And to see the problem in Africa, I have a few statistics. So forgive me, Prof. In high-income countries, 89% of people are financially included. Compare that with just 11% of people in low-income countries. And in Africa, 23% of adults have access to financial services. So 89 or 90% to about 20% in Africa, there's a huge issue. We talk about Islamic finance because it's one of the fastest growing segments in the financial sector globally. It's growing at about 15 to 20% per annum. It's currently valued at about $1.7 trillion. And as you'll see later, it could be